The COVID-19 outbreak will trigger an intense round of growth slowdown in China and of course across Asia and back home in Singapore as well. We at UOB believe that growth is slowing down, of course, to possibly 0.5% of GDP growth this year with a risk of recession. Most of the slowdown should be concentrated in the first quarter this year, possibly in the second quarter. Once the outbreak is brought under control, we can see a very nice V-shaped rebound in the second half of the year. The MAS has responded by issuing a statement that the Singapore dollar, on a trade-weighted basis, has room to trade lower in line with the economic weakness in the coming months. So that statement has triggered a broad and swift weakness in the Singapore dollar. If growth slows down further, we may have more acute weakness in the Singapore dollar over the near term. Once the outbreak is brought under control, growth should recover and the Singapore dollar should stabilize thereafter. Demand for commodities will be lower as well, and that affects emerging market currencies negatively as well. On the other side of the fence, you find that the US is going through a very sweet spot. Growth is very stable at 2%, inflation is benign, and of course, job market is very robust. This reinforces the short-term US dollar strength. Now, once the COVID outbreak passes, you will find that Asian currencies should recover and the US dollar should peak in the second half of the year. Asian central banks are now cutting interest rates aggressively to ring-fence and support the growth. In Singapore, we see money market rates stabilizing around the 1.5% low across the year, and they will only recover if we see a sustained recovery in growth.
Brought to you by UOB Privilege Banking.